Senator DeMint.
Thank you. Thank you, Mr. Chairman, for being here. My experience in business and politics tells me that most of the time when we're trying to solve problems, we're actually treating symptoms, and I'm worried about that with our political policies as well as monetary policies. It's pretty clear our current tax rates didn't cause the deep recession. As you know, they were implemented during a downturn in the early 90s. We had 6 years of growth. The problem clearly came from loose credit policies that resulted in subprime mortgages and toxic securities. And we have not really addressed that, except it appears that we over-addressed it from talking to a lot of businesses, home builders, realtors, that we've constricted credit to such a degree that local banks don't have the flexibility to deal with their local economies because the federal government and various agencies are telling them what has to be in their portfolio. So I feel like maybe the solution's much simpler, maybe not simple, but in effect we're not addressing that problem that would allow the flexibility. You know, we can't deal with the overbuilding of houses. It's going to take years to do that. But I don't think we've addressed the true cause, or at least a big part of the cause. Instead, we've tried unprecedented bank bailouts, unprecedented government spending, unprecedented federal monetary activism, and it's not working. And so I'm concerned about that. And the thing I'm really concerned about now is since 2008, the national debt has increased about 50%, but the interest paid on that debt's increased about 2%. And I think some of the things you're doing in the Federal Reserve is giving us a false sense of security. Last year, I think you bought over 75% of the debt that we created, which mask the real problem, and I think probably gives us a debt interest rate that's much lower than it would be. And part of my concern now is, as my colleague just said, that on one side you appear by these huge derivative markets and other things that are going on to have to keep our interest rates low. And on the other side, if you don't keep Treasury yields low, banks are going to park the free money we're giving them in Treasuries. It seems you're caught in a catch-22 now, where you have to work both sides of this to keep interest rates abnormally low, and you have to continue to buy Treasuries, or we'll be paying so much on our national debt that the fiscal problems we're looking at will complicate overnight. So we're on one side doing things that don't appear to address the true root causes of our problem. We seem to now be in a quagmire that we can't get out of. Now, I'm sure you have a totally different take on that, but I think you'd have to agree that the activism has been unprecedented and reason to at least cause some concern.
Well, of course, there's been a whole range of approaches and responses to this crisis, which, of course, was a terrible crisis and required a strong response. I guess I would comment on your point about interest rates and the federal debt. You know, the reason we keep interest rates low is not to accommodate congressional fiscal policy. The reason we keep interest rates low is because we think it's going to help the economy recover just a bit faster and keep inflation near our 2% target. Those are our objectives for low interest rates. But I don't think I would question whether or not low interest rates are in some way enabling fiscal deficits. The deficit over the last 3 years has been over $1 trillion a year, as you know, about 9% of GDP. If we were to raise interest rates by a full percentage point, and ignoring the fact that most debt is of longer duration and would not reprice, that would still only raise the annual deficit by something over $100 billion. So,
which is $1 trillion over 10 years. I mean, that's real money.
No, $1 trillion a year is what I'm saying, is what the current deficit is.
Right, but is the interest cost on that, if it would be $100 billion a year, we're talking about a trillion over 10 years. I mean, we are talking real money.
Trillion there, trillion here. Yes, sir. I agree with that. But what I'm saying is that the situation is the deficits are so large, particularly going out over the next few years, irrespective of the level of interest rates, that I would think that Congress would have plenty of motivation to try to address that, and that, you know, whether or not interest rates are currently 1.5% for 10 years or 2.5% just doesn't make that much difference.
I want to respect the chairman's time, but just one other point. My concern now is we're equating pro-growth economic policies with more government spending, and our president is talking about that to the Europeans. Austerity is bad, and on one hand, you're telling us this debt is creating a potential huge crisis, yet you're telling us we need to keep spending with more debt. What is the real signal here?
Well, first of all, it's not necessarily more spending. Appropriate tax relief would also help in the same way. But I've always said, and I said in my remarks, and I've said this a number of times, that you don't want to just do short-run stuff and ignore the long run. You don't want to just do long-run stuff and ignore the short run. You need a balanced program, one which at least avoids I would say, you know, a do-no-harm policy is what I'm looking for here. At least avoids derailing the recovery in the short term, but combines that with a strong and credible plan for reducing the deficit over the medium term. I think that's the best policy. It may be very difficult to achieve, but that, in principle, that would be the best way to go.
Thank you, Mr. Chairman.